Ajax, Ontario, the suburbs. We got a big show for you guys today. Power Band is rocking an auto fintech deal you've perhaps seen us writing about and tweeting about. We've got an NYSE CEO joining us later, David Lesser, which is this tiny little cannabis REIT. I had the pleasure of chatting with him not that long ago and said, hey, maybe you should come on and we can just riff on cannabis deal structure and sort of the whole REIT model and the opportunity that exists. We got some other big news that's happened. Actually, there really isn't much big news today, if I'm being perfectly frank. Although there is some. Trillium Gold announced a pretty big land package. We need to get into that. We're going to talk a little bit about the Big Mac Index, which George Gammons was tweeting about. Alcanna's, they're going to combine their cannabis operations with YSS Corp, 48 North. They lost their CFO. So there's stuff going on. We're going to have a really interesting conversation later on. So buckle up, buckaroos. We're about to get started. Joining me today is the great, let me make sure I'm in the camera. There we go. Is the great Jay Lutz.
Good morning.
Jason Lutz. Lutz Magoots. How you doing?
For those that missed it, Steve spent the last 10 minutes before going live here singing, so he's in a good Monday morning mood.
I've decided the Power Band is going to bring back the old Power Wheels commercial. Pow, pow, power band. Pow, 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 power band. Pow, pow, power band. So let's talk about it. I know I don't want this show to just be us talking about small caps and pushing our book, but hey, why else are we doing this?
Power band this morning, absolutely wild. New all-time highs hitting 68 cents. And if I'm being honest, I don't know what the push is even coming from today.
Pow, pow, power band. Pow, 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 power band.
But yes, I mean, Kelly's been doing a great job. John Lamb, Kelly and John Lamb were on a different show this morning. I believe it finished right before we got started here. I didn't get the chance to catch it, but I know there was some talk about it on Twitter, so must have went well based on performance.
Shout out to this Hammy. I don't know Hammy. I've seen him on Twitter. He's clearly brought his audience into the stock. And look, it's an exciting deal. There is serious risk capital in this one. This is a venture deal, and that's one thing that I think people do need to understand is this is they're not trying to accomplish something tiny that is going to result in tiny cash flows. I suppose it could be a little niche there, get a few dealerships signed up and reach that point. But make no mistake, I mean, they're going after the same market that Carvana, Vroom, and everybody else is going after. There's been a lot of other similar comps that have raised money through private equity and venture capital in the U.S. at valuations well north of here, raising a lot more money and still failed. So this isn't a slam dunk. But from a valuation standpoint, if you like the space and you like the name and you have some risk capital to throw at the auto fintech sector, I think that it's certainly an interesting name. I'm thrilled to see that the stock is continuing to show life, and I think that for retail investors, that's primarily what we are, right? We're two guys who didn't even work in finance or banking a few years ago. This is all kind of new to us. These are the kind of stories that certainly would have resonated with us, which is, there's this huge total addressable market. They're trying to create a product that's consumer friendly, and it's something that we get to watch evolve right before our eyes. So I think that this is exciting. I love seeing all the traction that's online, and I think it's going to continue. I reached out to John Lamb on the weekend on LinkedIn. He messaged me back, and then I just realized I forgot to message him back, because I'm not used to using LinkedIn. I hate LinkedIn. And I'd like to have him on maybe later in the week. He was on with Hammy today, so maybe we'll give John Lamb a chance to relax before we keep pushing him. But it's great to see the stock doing well, and I hope that it continues. So let's take a look at what's going on in the news today. Trillium Gold, they further consolidated the Red Lake District, and they've acquired Quebec-based properties. Jay, what can you tell me about this?
So, by all accounts, it looks like Trillium's looking to rename the Red Lake region the Trillium Gold region. They've acquired a further 8,000 hectares in the district itself. It's across 2 different greenstone belts in the region. The one property to me is notable just for the simple fact that it was the space between their Joy and Copper Lode property. So now that's one contiguous claim, which just further solidifies their spot in the region as a whole. There's a couple others that don't have a whole lot of historical drilling on them. However, there are some notable mines in the region as well as deposits. Outside of Red Lake, they now have property in the Larder Lake region of Ontario, which borders the Quebec border. There's a lot in this release, so I'm trying to remember it all. On top of that, they've also got a property in Fenelon, one in Val-d'Or, and one in Opalica, near to IAMGOLD's Monster Lake deposit. So they've acquired a ton of landmass as of this morning. They seem to have paid a decent rate, $618,000 over 3 years, along with 410,000 shares. There is a 1.5% net smelter on each individual property, 50% of which can be purchased back on an individual basis. I mean, truth be told, there is a lot of information in this release, and I implore you to actually dig into the release to get further details, because there's just too much for me to remember off the top of my head, and no one's going to enjoy me sitting here reading a release top to bottom.
Right. I'm not going to lie to you, it's pretty dry. I'm getting a little bit bored hearing you talk about it.
Oh, exactly, and that's the summary from the massive release this morning. But it's responding well on the markets this morning.
This is all boring until gold goes to $2,500 an ounce, and then everybody wants to know every single detail, down to the T and the I. And somebody tweeted at me on the weekend that they were finally looking at throwing in the towel on their gold plays, and I said, well, Barrick Gold's going to be trading at 5 times cash flow soon. You think that there's going to be very many portfolio managers sitting back and watching that and not hopping in? I don't think so. There certainly hasn't been the love flow into the major names yet. So until that happens, you're not really going to see the juniors really catch life unless it's like just based on a stock promotion. That's just my 2 cents. But Trillium, I look at this land package that Russell Starr, who's a friend of the show, and Trillium's also been an advertising client on the deep dive. So full disclosure, and I believe we're long as well. This is going to be a sexy name at some point. It's just a question of that trickle down, and that's not going to happen until the money starts to pour into the Barracks and the Newmonts, which will happen. They can only trade at 5 times cash flow for so long. This is a bull market, and gold just hasn't got the love yet. It looked like we started to there when Bank of America came up with a $3,000 price target for the shiny metal, and then we had Warren Buffett started buying. Was it Barrick he started buying? Yeah. It looked like that we were ready for launch, for takeoff, and then a lot of that momentum since has dried up. I think it's only a matter of time. I'm very, very comfortable. I sleep well at night, knowing that I own a whole bunch of gold juniors. Again, we're small cap guys. If you're risk averse, I would probably avoid the juniors altogether. I'd be focused on the Barracks and the Newmonts and the Franco Nevadas, because from a risk reward standpoint, you're going to make money on those, and I don't view very much risk there. But if you want your torque and you're looking for stocks that can give you that sort of 10 to 20x kind of exposure should gold run, and capital starts to flow into the sector, that's when you start to look at the juniors. And right now, there's a lot of things that I really like about Trillium. They got a CEO who I think presents very well, and he's going to continue to do more M&A and continue to drive shareholder value. I think that the land package speaks for itself. That Newmont Todd asset previously traded at $200 million in the last gold run. What's the market cap of Trillium today? Like 50 million or something like that. So just that asset alone, plus the Gold Center property, plus they've added today. I mean, they stole that package from Pistol Bay, which is, you know, right next to the like, it's like, what's it, like 50 meters from the Dixie project, which is Great Bear's, you know, $1 billion property that they're still trying to figure out what is. There's so many exciting lottery tickets in that package that it's only a matter of time until somebody wants to take a swing at it.
Oh yeah, I mean, the chances of nothing hitting at this point is just, to me, effectively zero. I mean, there's risk in anything, absolutely, but at this point, don't tell me that one of those properties will not shake out. Gold Center alone, I've said it time and time again, to me, Gold Center is their lotto ticket by all accounts, and I'm expecting a payout on that just based on historical transactions right next door, effectively, on the other side of Evolution's property. It's going to happen. The question to me is when. The better return shareholders can get, by all means, great. Like, it's just a matter of time.
Yeah. Okay. Well, and there's not really a whole lot for us to say with these gold junior names right now.
No, gold second win, right?
Right now, I feel like we are the people that were running around, and you know, with psychedelic deals in the summer, and nobody wanted to listen. And then all of a sudden, poof! Right? Compass goes
public. Yeah, suddenly everyone looks like geniuses.
And then, but the funny thing is that now I see, like, a lot of these psychedelic deals are really just shells. Like there's no real management team. There's no real assets. And, you know, they're catching tremendous life, tremendous bid, tremendous buying in the stock. And we're going to see the same thing happen in gold, where I believe that you could just, you know, close your eyes and throw darts at a dartboard with a whole bunch of junior gold names written on it. And you're, you know, more than likely going to make a lot of money. That's just my belief. That's not financial advice. I'm not a licensed financial advisor, but that's my take. That's how I've allocated my book, along with Jay. And it's, you know, aside from that, there's really not a whole lot to say about it. Like it's just, we're just sitting here, just saying the same thing every day, and we'll watch our audience continue to shrink as we do. But eventually we're going to be right, and then all these names we're talking about are going to have tremendous interest, and people are going to want to know more about them. And Bob's your uncle. But the thing that all you millennials out there, I'm a millennial too, by the way, by some measures. It's not, I don't think it's perfectly defined what a millennial is, but you guys want to hear about cannabis stocks. They're fun, they're exciting, there's stuff going on. So here's some news for you. Alcanna YSS Corp to combine cannabis operations in an all-stock transaction. All right, Jay, take it away, baby.
So this one's a bit messy by normal standards for the cannabis sector. Alcanna, if you guys recall, had a investment from Aurora Cannabis back in the day when they first got into cannabis retail. Now Alcanna is effectively looking to get out of cannabis retail. They're spinning out that division of their operation, doing a $25 million raise, and then combining with YSS Corp. I don't know if that's how you're supposed to pronounce it, but that's how I've always pronounced it. All told, they'll have about 53 operating locations, with a further 9 under development across Alberta, Saskatchewan, Ontario. I mean, there's not a lot to say here. Cannabis retail, by all accounts, you would think it's easy. You're selling drugs, literally. It's a tough market. Who else is in there? Fire and Flower, they've struggled to turn a profit despite all kinds of support and financing. Who is the other? Meta Growth, who combined with High Tide. It's just a very tough market to operate in. There was no valuation given for the company once completed, but YSS has been assigned a valuation of just under $23 million, and that's with a number of operating locations. So it kind of says the kind of sentiment for the cannabis retail space as a whole.
Okay, moving on here. 48 North. Let me pull this up here. They had some news today. What can you tell us about this?
So I want you to actually click on that link there. I don't normally include a link to the actual news release, But I just want to give a sense of how long this release was, where the company effectively hid that their CFO has left effective immediately. This detail was basically hid within the midsection of this long letter to the shareholders penned by the company CEO. And you don't really get a sense of why he's actually taking off after 3 years. The CFO that is leaving was with the company for the go public transaction, so it looks like he's just kind of lost faith. There is a saying that goes in capital markets related to how you should position when a CFO leaves, especially effective immediately. But again, I don't provide recommendations. So, I mean, to me, it's just noteworthy how it was a new way to hide it.
Just so I'm understanding this correctly, they put together a news release that was sort of penned, like a letter penned from the CEO, where he's just
as a letter to shareholders, just as a blanket corporate update,
where he dropped the tidbit that the CFO left,
and effective immediately, and they have an interim replacement.
Let me see if I can find this part here. Okay, here it's right here. Let me pull this up. Sorry to everybody who's watching me. There we go. So it's right in here. Effective immediately, the company is announcing the departure of Chief Financial Officer David Hackett. On behalf of the entire 48 North team and our board of directors, I'd like to thank David for his time at the company. In his 3 years with the company, David helped us navigate many of our largest business milestones, including taking us public in 2018. We wish David all the best in his future endeavors. So there's a lot of thoughts that pop up in my head when I hear something like this. One is, it's a CFO. A lot of these publicly traded companies are using a CFO who's, the CFO of like 10 other companies. So, and some people use the term, it's a rent a CFO. Well, I don't really buy that. I think that in some cases companies are simple enough that they don't need to spend $100,000 a year for somebody to do some pretty basic books. That makes sense in mining. Buddy wrote an article in the Globe and Mail not that long ago about Canadian stock promotes and how some of these CFOs are listed on a bunch of companies. It's like, well, yeah, for a junior mining company, which is effectively just a piece of real estate placed inside of a public vehicle, that makes sense. 48 North is an actual real operation where I would assume that the CFO is full-time and a big part of the organization. So it probably is pretty meaningful. And it's obviously makes you wonder if, there was problems or if the opportunity just doesn't excite David anymore, whatever may have happened. But, it really what it does is it begs this question I have for you here, Jay, which is there life for the Canadian cannabis operators? What do you think?
That's a very loaded question.
I wrote this while I was typing, so I don't love the wording of it. Let me
so there's so many different ways you can go through this. Craft operators have, by all accounts, been doing amazing. I don't know financially, but there's a lot of private cos that have been doing great. Look at Redican. 48 North here, or not 48 North, North 40 in northern Saskatchewan has built a massive following. I don't know what financials look like for these private operators, but at this point, I'm assuming the financials can't be that bad if private operators are doing it without endless public transactions to fund operations. Now, there may be stuff going on behind the scenes. Again, I don't know. But in terms of public operators, they seem to be struggling to no end. The amalgamation this morning between Alcanna's Cannabis operations and YSS Corp is just another sign of that. It's tough, right? I mean, it's a sector that so many people enter thinking there is a road to riches, and they didn't look at the long term and go, it's just going to be commoditized, right? Outdoor grow, such as 48 North, has really helped to commoditize things. There's all kinds of backlog. Notably today, 48 North didn't comment on how the harvest went. I don't think they have yet, based on some comments I saw on Twitter. I could be wrong on that, but I don't think they've actually provided guidance for how things went with regards to that. This morning's release was a lot of words while saying nothing aside from the CFO departed. You saw how long my version of the release was there effectively. And the only thing noteworthy was what was included, really. Their guidance was so thin that there was nothing to be said. They intend to provide guidance on their path to profitability later in the year. Guidance on a path to profitability doesn't really excite me, and I don't think it excites investors at this point in the cannabis market either.
So I want to pull something up here. This is from Y Charts. I want you guys to look at here cash flow from operations trailing 12 months. For me, I love cash flow from operations for cannabis companies at this stage. It tells me, they can put out their adjusted EBITDA numbers. They can market whatever they want, put whatever they want in a news release. But at the end of the day, you can't lie on the cash flow statement. And look at this. Afria, negative 135 million. Canopy, negative 680 million. Aurora, negative 351 million. Kronos, negative 210 million. Organigram, okay, only negative 7 million.
I'll be honest, I'm impressed with the Organigram with that number. As bad as it sounds.
And Hexo, negative 66 million. To me, this is a really, really important talking point, and that is to say that, there was all these great intentions for the space, right? We thought, I think Deloitte came out with that $8 billion number that showed up on every investor deck. We were all told, oh yeah, we're looking at, 35 to 40% EBITDA margins. And each of these companies were acting like they were going to get top 3 market share, which would equate to, $1 to $2 billion in annual revenue at 35 to 40% margin. Then you're doing, $350 million in EBITDA. Multiply that by 10 times, you're now at a $3.5 billion valuation and ready to take on the U.S. But let's not forget Germany. We've also got Germany. So that opportunity is huge. And now we look at it and we're kind of left scratching our head going, oof, Germany, that's not really happening. US, they all went on the CSE and listed and raised money and started doing things. And of course, the TSX, NYSE, and NASDAQ didn't really want them playing with, US operators. So what are they left with, right? Like, is there, why am I buying Afria, Canopy, Aurora, Kronos, Organigram, or Hexo today? What's the thesis? Give me some hope, Jason. Why would I buy this stock or hold on to it? I'm holding on to it. Maybe I'm down 50%. I bought it, a year ago, 2 years ago. What's the narrative to tell me not to sell my shares and hold on? What is it?
At this state in the Canadian cannabis space, it's tough to say, right? Like,
I want to make it clear. I'm not asking you to tell me why to sell my shares. Tell me why I don't sell my shares.
Oh, so you want me to play?
I want you to play devil's advocate.
I'll do the devil's advocate. All right.
What's the thesis? Please tell me what the thesis is.
So this one's tough. Let me think it through. So in terms of companies that have a U.S. listing, there could be a path. We saw that with Hexo this past week with their arrangement with Molson Coors in Colorado. Afria, Sweetwater, Canopy, their hemp operations, but no one likes hemp. They do have stuff going on with TerrAscend, which they've doubled down on, as well as Acreage. But if you don't have a U.S. listing, it's tough to play devil's advocate. And when I say U.S. listing, I'm not talking OTC markets. I'm talking NASDAQ and I'm talking NYSE, to be clear.
So if we're looking at the Weed MDs, the Supremes, does the Supreme have a U.S. listing?
Maybe OTC.
Oh yeah, no, but they're not NYSE or NASDAQ.
No, I don't believe so.
So the Weed MDs, the 48 North, the Supremes, the
tier 2, I think
they're all in trouble.
I'm struggling to come up with a long-term bull thesis, even playing devil's advocate as much as I like that. It's tough, right? I mean, absolutely, is there space for expansion in certain small markets within the Canadian cannabis space? I'm sure there is. Beverages, we still need some solid tasting beverages, but we all know the size of the beverage market. I'm bullish as can be on the beverage market, but that's only so big. It's not very large. Edibles, Indiva, that's probably the best in terms of now tier 2, given they have 40% market share. Can they maintain that? Who knows? I doubted them up to this point, so I'm nervous to say any other direction. But someone that's just at its core a grower, to me, you got to be able to get costs so low that it makes sense. Outdoor grow is probably the path for that, as they get used in different edibles and that. But then you've got guys like Willow Bioscience, who has near-term commercialization of CBG. We all know how close CBG is to other cannabinoids, and at some point, that's probably going to become the dominant path rather than going the extraction route. So suddenly you've got this commoditized product, and you're losing avenues for sales. So what is it then, right? There's only so much value cannabis that can be purchased by consumers. I mean, I guess the direct comparison to beverage alcohol would be beer, but even still, there's only a few players that dominate that market. Sure, craft is craft, but we already have that in the cannabis space, and that's not mass-grown stuff.
How important do you think that quality of product really is for, your typical, that bulk, like the majority of cannabis users? And the reason I ask this, and something I think about quite a bit, is Trulieve does not have great reviews of their weed, right? Like people who smoke flower say that Trulieve's weed isn't great. It's grown in hoop houses in Florida, which is a very challenging environment to grow in. Yet they have this dominant market share. So it's something I think about quite a bit. Is I know that that's like in the early stages of this whole cannabis cycle, we were told that quality matters, but I don't know. Like it's something that I do put a little bit of thought into, and I do wonder if
Here's the answer to that. So the best comparison is alcohol, but by all accounts, it's alcohol. I just pulled up the data based on the U.S. market. It comes from ParkStreet.com. 81.2% of alcohol sales comes from malts. So to me, that's largely beer. So there is a large market. Actually, in the announcement this morning made by Alcanna, they announced that about 80% of their stores will be switching to a brand name called Value Buds. And that's because of the strong demand seen for the cheapest product you can get that will give me a buzz, aka the beer of the world, or the beer of the cannabis space, right? So there's certainly demand there. Is it going to be a massive revenue generator? On scale, yes, but if you're a small operator with 10 acres of outdoor that you can grow, it's not going to provide you any type of decent margin unless you can do it incredibly cheap.
Okay, let's take a question here. This is from the Semi-Pro. He's a good dude on Twitter who I know is a big PBX guy. Thoughts on Sproutly, potential small cap with lots of room to grow on the Canadian aid, I think he means side. You got any quick thoughts on Sproutly, and then we'll move on to our guest?
Honestly, I know nothing about Sproutly. I used to follow them, but that was 2 years ago, and I could not tell you where things are at currently, so I can't provide proper commentary.
One of my best friends did the plumbing for their facility in Scarborough. That's that I do know, and I think that it's a beverage story, right? Like they had like these patents on this beverage tech. They also had a really high end facility in Scarborough. But in terms of like the overall opportunity, look, I like beverages. I think beverages are at some point going to be a really interesting opportunity. I'm not sure where Sproutly trades at today. Let me pull this out here. Pull this up here.
Looks like they're looking to be an ingredients company for the beverage sector.
Is Sproutly now a 5-cent stock?
Looks like it.
Oh, geez. This was $1 stock when they announced that Moosehead deal.
That's who it was, yes. I couldn't think of the name. I don't know what the status of that is or anything at all, if I'm being honest.
Yeah, I don't. I like beverages. I'd have to spend some time looking at the financial statements, breaking down the balance sheet, breaking down the income statement, and happy to do that. Maybe we could do that sometime live on the air with our audience, just kind of walk through it and just sort of give our high level thoughts. But typically in micro caps and small caps, when the stock gets beaten down to 5 cents, you do often sometimes see a bit of a bottom feeding opportunity where they do try to bring in some new shareholders, a new group, and then they try to run the stock. So it's kind of consolidated there at 5 cents. Here I'm talking technical analysis, which you know how much I hate. But I've seen this happen in micro caps and small caps. So that's my thoughts on Sproutly. I don't know a whole lot about what they have going on. I love the beverage space. And heck, at 5 cents, I don't know, it could be interesting, but I seriously don't. I'd have to look at the balance sheet and cash flow statement and everything. So let's move on. We've got David Lesser is going to be joining us. David, can you hear us?
I can.
Awesome. How are you doing today?
I'm doing great.
Is there any way for you to turn your volume up a little bit? We can't really hear you. Let's see here.
Did that help? If not, I can try a headset.
Yeah, maybe if you want to try a headset. Let's try now. Or we'll give you a minute. This is the fun thing about doing a live show is we do all the stuff that a producer should be doing live on the air. Can you hear us now?
Is that any better?
It's you're still really quiet. Is it quiet for you, Jordan?
Yeah, it is coming across quiet. If you tap the settings button on the bottom there, it may not have changed the audio input for you yet.
Oh, I see. Audio input. It's on one bar. Oh, is that any better?
There we go. Oh, there we go.
Way better.
We got volume now. We got volume. Look at that. This is riveting television. Troubleshooting live on the air. No, that's perfect. So, David, thanks for joining us, and especially on a holiday today. Are you working today or spending time with family? What do you have going on?
I am working. I think I'm always working, but as I say sometimes, the definition of being retired is doing what you love, and I love to work. So I'm retired, but I'm working, and I work full time.
Okay. So what brought you into cannabis?
Yeah, interesting story. The background for Power REIT was not actually to focus on cannabis per se, but I was looking for sort of an industry that was ripe for capital formation and technological transformation. And I settled on the controlled environment agriculture space as something that I believe is poised to really take off in this country. And I spent a lot of time looking at a number of transactions, initially around food cultivation. And I think that's a huge opportunity and a huge growth story here domestically in the US. And the cannabis topic kept coming up, and I had people approach me and say, well, if you're really focused on this controlled environment agriculture opportunity, why wouldn't you look at cannabis? And initially, frankly, I did resist it, but ultimately was able to get some transactions over the finish line, and the economics proved to be very compelling. And therefore, we dipped our toe in, the market reacted favorably, and I guess the rest is history. We've continued in that direction, although I would say, once again, broadly, our thesis is more on controlled environment agriculture, not necessarily limited to cannabis. But right now, certainly the cannabis economics are favorable. And so the bulk of our pipeline certainly continues to be focused in that direction.
Okay. So how does the impacts of, Biden, and here we got the Dems now sweeping everything, the House, the Senate, and the presidency, how does that impact the cannabis REITs?
I guess it needs to play out. It's a little too early to tell. A lot of the legislation that is out there, I think, will simplify things more for our tenants and operators, which I think is a good thing. But I don't think near term will have a significant impact on the opportunity, sort of the growth opportunity that we see in front of us. we still believe that this is a capital-starved industry, and some of the legislation out there really doesn't address that as much as just simplify the more day-to-day operations that our tenants certainly struggle with.
Okay, so one of the things that I find kind of interesting here is you guys are running this model as a REIT. There's only one other REIT that I believe is listed in the U.S. That's IIPR, which is backed by big deep pockets. I think that CEO formerly sold his previous company for like $500 million or something like that, and they've got a lot of cash on their balance sheet. Here, you're effectively a tiny micro cap. This is kind of a special situation. We got a tiny micro cap. What's the market cap of Power REIT? Like 50 million?
Yeah, we have currently just in round numbers 2 million shares outstanding, and our stock is at about $35, so call it 70 million in terms of the equity market cap.
Okay, here, let me pull this up here.
That is a wild number. I don't know that I've seen that little in terms of shares outstanding before.
Right. We also it gets compounded a little bit because we have a relatively small float. We have some sort of long holders, but then also most significantly, I am a very significant holder, and obviously I'm not looking to sell. So it's great because it means that I am very aligned with shareholders, and I can assure you I am very focused on creating long-term shareholder value. That is my mission here.
Okay, so one of the things that I find kind of fascinating here is just the deal structure of the REITs. Can you explain it to us and our audience, like we're 5 years old, of how this works and why the NYSE allows you guys to list when you're sort of a U.S. cannabis operator stock? I know that you're not, but you are playing in that sandbox. How can you walk us through A, the model, and B, why the NYSE allows this to even occur?
Before I jump to that, back to the market cap and shares outstanding topic. We do currently have a rights offering, which I view as a very investor-friendly approach for us to raise capital at this stage of our growth story. And so that is out there, and it's too early to tell how much we will raise in that rights offering, but it should have a meaningful result in a meaningful increase in the number of shares outstanding. So that's something that is ongoing as we speak. And then obviously the point of that is to provide the company with capital to continue to deploy. And as the market has seen, we're deploying at very high unleveraged yields on these acquisitions. And so deploying the capital from the rights offering is very accretive. And the goal is that can create shareholder value. What we wanted to do was really give that opportunity back to our existing shareholders and allow them the first right to provide that capital at this sort of early stage while we're still a very small company. And I know you guys really focus on smaller and microcap type companies. As you guys can well appreciate, it's easier to grow a small company than a big company, and we are a small company. And it's even easier and more impactful when you invest at the types of investment yields that we've been demonstrating to date. So I'm very bullish on our growth prospects, and I think it's going to be interesting to see how this rights offering unfolds. And as I said, it's right on top of us right now. It's ongoing. So in terms of the deal structure, we've been investing really focused on cultivation facilities. And as I said, our focus on controlled environment agriculture. So we are essentially leasing to cannabis cultivation companies. Sometimes they're vertically integrated and have their own retail distribution. But in our case, our properties are purely focused on what I would refer to as essentially a plant factory. And we're doing it in that controlled environment that I described. So that's really our business plan. The deal structures we've done to date are quite powerful from our standpoint, but I also, as I've said to many of the tenant operators that have had the discussion at the front end of the discussions, I've said, well, our capital is by no means cheap. Obviously, it's interesting to us at these yields. I think it's very cost-effective capital for those companies who are seeking capital, because for them to raise the capital to pursue this type of facility, in a normal type of offering, equity offering, they would suffer significant dilution. They'd sell a big chunk of their company to raise the capital, whereas we are non-dilutive capital to them. And therefore, from that standpoint, it can be viewed by them as cost effective. And yet, from our standpoint, it generates attractive yields. So in terms of the yields that we've invested at in all of the transactions to date, we have generated over 18, approaching 19% type unleveraged, what I call FFO, funds from operations yields. FFO is the term of art that the sort of the REIT industry uses primarily as a sort of a proxy for earnings, although it is not earnings, it's not GAAP earnings. And so our funds from operation yield has been in that 18 to 19%. I will say for the deals we've done to date, in my mind, as an investor, I feel like that understates the quality of those deals from a structure and cash flow standpoint, because the structure of the leases that we've done to date all have a very front-ended cash flow back to us, essentially to return our capital, our entire invested capital in the early years. And so therefore we de-risk the asset from our standpoint, but in exchange for that, what we have explained to the tenant operators is that they get a lower long-term ongoing rental payment, which in my mind sets them up for a more sustainable future, if you will, by being more competitive out into the future. When I think in this industry, we can all expect capital will become more efficient than certainly it is today, where it is quite inefficient for these cannabis companies to raise capital. So we think it's a great structure for us as well as for them. I can't say that we will always be able to continue with this structure, but right now it has traction, certainly with a number of deals we've completed, and we continue to pursue transactions on similar terms, although, as I said, I imagine it will continue to evolve and adjust as we go forward.
So you're based out of New York, right?
I am.
Yeah. So it's kind of interesting when you talk about the inefficient capital. Like you look at a lot of these U.S. cannabis operators, you know, they're generating EBITDA. Some are generating cash flow, some aren't. I'm sure you talk to a lot of people on the street. What's the perception or the appetite from your perception of investing in cannabis companies, and how much has that changed over the last couple of years?
You know, I have not been at this for that long. You know, we made our first investment in the cannabis space about a year and a half ago, and I can't say before that I'd really thought about it all that much. So in terms of how it's changed, I mean, I certainly read about it and see the references to some of the issues in the early stage and kind of the references to now Cannabis 2.0. So I certainly see increased appetite. I mean, it just is the natural evolution. I do see that certain investors feel more comfortable investing in a company such as ours that is not, as they refer in the industry to, you know, so we're not plant touching, so we're certainly a step removed. And then also just from a sort of downside security. I mean, the beauty in part of a REIT that really is entering to net lease type leases and long-term triple net leases is that our earnings are fairly predictable. Obviously, you have some tenant risk, but our earnings are fairly predictable. And so it's maybe a lower risk opportunity for investment dollars relative to the quarter-to-quarter gyrations that you really see in a more operating type business. Certainly in the cannabis space, you've seen a lot of gyrations of earnings. And given that it's still at the early stages of the emergence of this sort of public capital markets for cannabis companies, you know, there have been trials and tribulations and a lot of gyrations of those companies. Whereas I think what you can see in a real estate investment trust, look, we have the downside protection because at the end of the day, we own the hard physical asset, the real estate. And then we also have more stable visibility into earnings. So I think that it's a good place for people to dip their toe. And we're starting to see that even in our small company with some ETFs and small funds starting to take positions. Our hope is that through this rights offering, as we certainly look to expand our float and our market cap, we're just at the early stage of this, and it should accelerate hopefully quickly.
Okay, I want to try to explain what a rights offering is on the air here for our audience, and correct me if I'm wrong, but effectively what a rights offering is you're just going to go to your current shareholders and you're going to say to them, everybody gets a warrant. And that way they get a chance to participate in a financing. There's you get a 1-for-1 based on the current number of shares you own, and that way you use your current shareholder base to do the next financing. Is that an accurate description?
Yes, it is. The 1-for-1 is something we established. Obviously, sometimes there are different proportions in terms of rights offerings, but we basically gave each share the right to buy 1 additional share. And to the extent investors fail to subscribe for that additional share for whatever reason, we provided an oversubscription privilege to shareholders who do participate fully, that they can then subscribe for additional shares. And as you said, it really gives our existing shareholders the right to finance this next stage of growth. And again, I don't want to say it's purely formulaic, but we believe that by deploying capital, and you have on your screen a page from our investor deck, by deploying capital even at lower yields than we have been doing historically, and we provided some sensitivities in this chart, we can create significant shareholder value. And so we wanted to give that opportunity back to our existing shareholders who have been with us. And I imagine in the future we might pursue more traditional capital raises, but right now we thought this was a great opportunity for our existing shareholders to get that right.
Is there any terminology, any sort of clauses or pieces of within the deal structures that you're doing with these operators where they can buy back their asset?
We have not, in any of the deals done to date, we have not had any kind of buyback option. Not saying in the future that's not something that might creep in, but right now our story really is, no, we are a long-term permanent capital source, and that's not something we've offered.
Okay.
What kind of payback are you getting in terms of paying the facility off after purchasing it from the future rentee, I guess? Just in terms of what's the risk of a company going bankrupt in 2 years? Are you left holding a bag effectively, or are you free and clear?
Right. So as I described before, for the transactions we've done to date, we have typically a deferred rent period at the front where there's no cash rent, and that allows for a period of time for the tenant to get the facility up towards operation, up towards revenue. Maybe doesn't get them all the way to revenue, but certainly gets them towards operation. After which, all of the transactions that we've done to date return 100% of our capital for the next 3 years. So from our standpoint, it's a bit of a cliche, but most businesses that fail sort of fail in kind of that 18 months to 2 years period. If that were the case in our deal structure, we would have gotten back a significant amount of our capital and still own the real estate, which obviously then we can find a replacement tenant for. So I really like the fact that this significantly de-risks our, each investor as part of this sculpted cash flow structure of our leases that we've been doing to date. The other thing I really like from an investor standpoint is that it provides additional capital that starts to rapidly come back to us, and we can use that to invest and continue to build our portfolio and build our cash flow, our FFO, and again, that should help generate significant growth without having to access the capital markets. So, for example, to date in this CEA investment opportunity, all related to cannabis so far, we've invested about $24 million. That's our sort of total committed dollars to these deals. For all of those deals, over the next 3 years, roughly, we will get that $24 million back. And so if we were to turn around and then invest that at anywhere close to the yields we've been investing at, it does add meaningful impact to our FFO without having to access the capital markets. So it's pretty powerful from that standpoint as well.
Yeah, so once 3 years get going, then you really start to roll into positive, I don't know what you call it, cash flow from that, but it works well. Is there certain jurisdictions where you like, or where they perform better than others with regards to that, or is it pretty standard across the U.S.?
So we've done this in the state of Colorado, and we've done it in the state of Maine. We have term sheets out in many other states, really any state that has some form of legalized cannabis activity. So we're open to investing across the country, and certainly some of the restricted states, really heavily restricted states, have a real supply and demand imbalance for cannabis. And so you see much higher prices, for example, for cannabis in some of the states than you would, for example, in a state like Colorado where we're active. But even in the state of Colorado, where prices are lower than some of those other, call it limited license states, where you have that imbalance, we see that our tenant is able, on a projected sort of cash flow basis, they are able to pay that inflated front end rent that we talk about, and they like that because they then get that in exchange for a much lower long-term rent. And these operators are really into it for the long term. And I think they also look forward to say, wow, at some point, once I prove this operation out and maybe expand it a few times, that lower rent really is going to help when and if they look for some kind of exit of their company, the tenant's company. So I think it's a good structure, and so far it's working for us as well as for our tenants.
Are you guys paying a premium because these facilities are licensed for cannabis? I saw when I remember when Michigan first started moving towards going public, I'd see like all these, like effectively abandoned factories where they'd get, somehow it'd be a potential like zoned area or whatever. And what should be like a $50,000 property, they're suddenly trying to sell for, $500,000, $1 million. So that's one of the things that would probably be my first thought when I think about this model. How do you sort of evaluate or put a price on these assets that have this licensing that creates risk should the licensing open up?
Yeah, so my background is in real estate finance, and real estate securities. And so I'm very focused on the underlying real estate fundamentals and not getting sort of caught up in some big cannabis premium as it relates to our investment. Certainly our deal structure, if it was a more mainstream real estate asset class, we couldn't get anywhere near these types of yields, absolutely. But because of the challenges that cannabis companies have raising capital, it creates an opportunity for us to deploy capital at these types of yields. Now, in terms of the real estate fundamentals, I am trying not to go to extremes and say, wow, this property is, $100 a square foot, but because it's cannabis, it's $200 a square foot, and that's fine. I don't think that's necessarily fine. So we're not looking at that. And I think if you look at the deals we've done to date, our prices per square foot show a certain level of discipline. And I think that's an important thing that we will continue to focus on going forward. From our standpoint, we really try to look at, okay, what is, for example, replacement cost for that asset, and try not to be out of whack in a meaningful way from that, just because it's cannabis. We're not trying to provide that big premium on top of it. What we're really trying to do is come up with a deal structure that gets us an attractive yield, but not get crazy in terms of, call it the dollar per square foot for a simplistic way to think about it.
Okay, yeah, because that would be my concern here is if the regulation environment didn't show up in your advantage, that you're left with all these overinflated assets on a balance sheet. Another question I got for you is the rights offering. To me, we mostly speak to retail investors, as we like to say, the butcher, the baker, the candlestick maker. The rights offering, I think, is just so interesting if you are a retail investor, because you're not playing with some of the bad apples that especially exist in micro cap and small cap that do these types of financings. Why do you think it is that more companies don't pursue the rights offering?
It's a good question, and one that I don't have a great answer for. I have, when I first got involved with what is now Power REIT, we did a small rights offering, and I thought it was very interesting. At the time, the company had a single asset. I had essentially taken over, stepped onto the board and took over and started with a business plan and said, we need some capital. And we literally had no money in the bank. We had an asset that was cash flowing, but the company as a REIT was basically paying out almost dollar for dollar what came in as rent, paying it out as dividends. And so we did a small rights offering because for the size, just to get a little bit of working capital and a starting point, no investment bank would have taken us seriously. So, I think that there's a mistaken view that very often rights offerings are done for distressed companies that have no other option. I think in our case, certainly, that this was a conscious choice. This was not we have no other options. I think we had great options, and we have tremendous interest in what we're doing. The biggest issue has been, frankly, that people couldn't deploy enough capital into our company. Our market cap was simply too small. So we think this gets us in the right direction without our shareholders suffering the dilution of maybe a regular way public offering that might have been at a lower price. And to the extent anyone disputes the price, the shareholders are the ones who got the value. So in our case, I think it is likely to prove to have been a good approach to this next phase of raising capital. I don't think it applies in all cases, but I do think it may be something that is somewhat underutilized.
How do you go about diligencing an operator, right? Like there's a lot of characters in cannabis, as I'm sure you're well aware. How do you figure out, if their financial statement, my understanding is a lot of these companies, they can't even get audits, right? They have to go and, find an accounting firm that will even do it. And then, they often have backgrounds that are a little bit hard to even verify. So how do you go about figuring out who's trustworthy as an operator and who's ultimately just going to leave you with an empty warehouse?
Sure. So I, to some extent, look at this more as a project financing than sort of a credit decision, okay? And as such, we can sort of look at, okay, here we know what the cost of the project is going to be. That's pretty predictable. Our structures tend to be modular greenhouse type structures, so you can pretty well de-risk the construction side and the cost. So we can come up with a pretty discrete view on what it's going to cost to build. And we could similarly come up with a pretty good sense of what it costs to operate the facility. We typically ask our tenants, obviously, to underwrite and give us their projections. And ultimately, the biggest factor driving the bottom line projections, because there isn't huge costs associated with these operations, the cultivation side, the biggest driver is going to be what can you sell the processed cannabis for? And obviously, that's something you can get some data points and sort of use that to get at least a near-term projection of cash flow. And that's really what I'm focused on. And if it can then cover our rent with some nice coverage, then it looks like a transaction we would take to the next step. At the end of the day, that's the financial equation that I'm underwriting. Then the question is, can this tenant operator actually perform to that plan? And so what we look at there is, what are they doing? What have they done? What track record do they have? And so we would typically go out and visit their existing facilities and see and get a gut check as to their ability to grow and then process and then sell. And if we get a level of comfort that they can do that, then we try to move forward with the transaction. So ultimately, the numbers are not that complicated, and it's somewhat of a gut check based on the track record of the existing team as to their ability to operate per that plan.
I find this slide here really interesting. I'm a former teacher, so the idea of a case study and just going through like a mathematical example is something that sort of excites me. Can you walk us through this deal structure and why it worked for Power REIT and just sort of the high level for our audience?
Sure. So we actually bought this this transaction. It was an existing property that was built. It was, I would call it, probably 95% complete when we acquired it. We're not doing anything on spec. So for us to buy it, we needed an identified tenant. Okay. And so we were introduced to a tenant who knew about this opportunity. They didn't have the capital to acquire the property, but they had demonstrated their ability to operate in the same state. They had several dispensaries that they've been operating for a number of years, which got us comfortable with their business acumen and ability to run a business. And they had what I'll call some indoor cultivation, but they really saw the opportunity to pivot to greenhouse cultivation. So we provided the capital. We bought what was at that point a relatively small greenhouse with the absolute contemplation that we would work with them to expand. And then, frankly, fairly shortly after acquisition, I would say within roughly 6 months, we announced a pretty meaningful expansion of that greenhouse. And you can see in that top picture the construction at the time. That greenhouse is now 100% complete. The bottom picture is what it looked like when we acquired it. It was what we call a single bay greenhouse. And we then went on to add, I think, 3 bays to that shortly after the acquisition.
So when is the rights offering coming due, and in what sense do you get of how much of it's going to get exercised?
Too early to say how much will be exercised. The closing date is set for actually this Friday, so it's right upon us. So the mail has been coming in, and it really is too early to talk about how much has come in. We'll obviously put out a public announcement when we do go ahead and close.
So we've focused nearly the entire show on cannabis. However, within your deck, you outlined two other areas in which you currently have property. One is solar farms, 600 acres of land on which that is, as well as 112 miles of railroad, which to me is kind of unique. Can you speak to that a bit? How you acquired it and what it's used for specifically?
So starting with the railroad, this company actually was originally a company called Pittsburgh and West Virginia Railroad, and it was a REIT that actually dates back to the 1960s. And the company basically acted as a single asset REIT for all of those years until I got involved, call it 8 to 10 years ago, I'm not sure exactly. I saw this company as maybe a platform to try to do some things, and acquired stock in the company, became the largest shareholder of the company, and went on the board. And the pitch I made at that time was, it really does not make sense to be public with all the costs and so forth with this single asset. If we're not accessing capital, we're not growing, there's really no reason to stay public. And the initial thesis, because I have a background in alternative energy, the initial thesis was to focus on alternative energy assets, like sort of the real estate component, the real estate infrastructure associated with alternative assets. And we looked at a bunch of transactions. Ultimately, we got a handful of acquisitions done for ground leases under utility scale solar farms. At the time, the solar industry in this country was pretty early, kind of still fairly entrepreneurial. And I saw an ability to deploy capital at what I thought were really mispriced risk-adjusted returns, because we were owning the land underneath our tenants' massive investment, where they were funding the cost of all of these solar panels, infrastructure, inverters, the upgrades to the utility, to connect to the utility, the interconnect, and so forth. So they had a massive investment. And so, for example, our largest transaction that we did in the solar ground lease space was, I think, a $9.2 million acquisition. Our tenant invested in the range of $200 million that is sitting on our property, that for all intents and purposes cannot be moved. It would have far less value if you try to pull it apart and sell off the pieces. They also benefit from a long-term power purchase agreement. So they're contractually obligated to maintain that facility on our property. And that offtake agreement calls for the utility to buy all of the power they generate. So I looked at it and said, wow, so you can pretty well predict how much power a solar panel at a given location will produce over the course of, let's say, a year. You know the price that the off-taker is going to pay, so you pretty well know your revenue. There are not huge costs associated with operating a solar farm. There's some basic maintenance. And so you can pretty well predict the cash flow. And we were essentially at the top of the chain, the food chain, if you will, for getting paid. And we were a relatively small sliver of the overall project cash flow. So I felt like we were highly, highly, highly secure in our cash flow stream. And therefore, the yields we were getting at the time were very attractive. Now, again, this was at an early stage of solar in this country. Fast forward to more recently, and solar has become quite capital efficient. And so therefore, we don't see opportunities to continue to focus acquisitions in that direction, which is why we were looking for a new area that was sort of at that same stage, early stage of people didn't fully understand it. It was just getting off the ground, early stage of capital formation. And that's where we, again, identified CEA, controlled environment agriculture. And I'd like to think that we're once again at the early stage of something that's poised to take off, and that we can benefit by building this sort of book of business and really deploy capital on what I think are attractive risk-adjusted returns.
Well, that's interesting. So you're an ESG stock and a cannabis stock.
We are. In fact, we just announced an acquisition where we're, for example, backing a minority and woman-owned business as a cannabis tenant operator. And yeah, we really are, I think, an ESG triple bottom line, whatever you want to call it. We are that. We think that our cultivation facilities are the sustainable business model, and have a the sustainability benefit for our environment as well. So we're really, I agree with your point.
So quickly, then we should probably wrap it up. But what kind of cash flow does the solar farm generate?
So across all of the solar farms, it's relatively small, but we have about $1 million a year of revenue, sort of that contributes to our FFO, but a revenue that comes in from the solar farms.
Okay, cool. Jay, you got a question? I can see.
Yeah, my last question. And we've been on calls before, and this has bugged me forever. What is hanging on your wall?
So it is just a piece of art, but it's basically a rusty old car that I hung on my wall because I thought it was super cool. And I've certainly gotten a lot of questions here in the world of COVID as I've done a lot of Zoom calls, so it becomes a conversation piece.
I absolutely love it, and that's the only reason I was asking.
I think you've given Jay a new goal in life, which is to have a part of a car on his wall.
I'm glad I could help.
Well, thanks so much for joining us.
Thank
Dave.
you.
This was fantastic. I think this is a really interesting name. I think it's a special situation. You got an NYSE stock trading at a tiny market cap, which the only comp is like, I don't know what IIPR's market cap is, but I assume it's around. Do you know what it is off the top of your head, like ballpark?
It's up there.
I'll pull it up.
Google tells me 4.2 billion.
I was going to say $1 billion, and I thought I was going to come in too high. It's $4.2 billion. And here we got Tiny Power REIT sitting at, according to Y charts, about 68 million. So it's a very special situation. Clearly, we got a real custodian of capital here, which is something that I think cannabis investors ought to be a little bit more worried about whenever they look at any of these names. There's usually a bunch of deal guys behind whoever's, being the CEO that are playing to blow out shares in the retailers' faces. You got a lot of skin in the game. You believe in this thing, and you've clearly put a lot of time into diligencing every deal that you've done. So thank you very much for joining us. This is really interesting.
Thank you, guys. I really enjoyed it.
Okay, so Jay, what do we got going on this afternoon in the dive?
This afternoon, we've got some macro stuff. Not a lot going on in the markets as we addressed first thing this morning. For the daily dive, we have John Ryan starting off this week talking about some assets they put out right before Christmas, actually. He provides a great, quick little interview. I think it's about 10 minutes long, as per normal. Outside of that, bit of macro coming from Hermina Paul. I believe there's some stuff coming out on GM later today related to what they're doing out in Ontario with electric vehicles. Other than that, that's about all we've got going on. Tomorrow, I'm expecting a lot of news, given that it's a short trading week down south, and U.S. operators are looking to get the news out these days. So, as always, we are entertainment purposes only. Strictly opinions here. I have no financial related designations or licenses, nor does Steve. So take it as you will.
And to everybody who joined us today, I appreciate it. It's so much fun getting to come on here every day talking about cannabis, talking about small caps, things that we love. I've got an interview in 20 minutes with the Bruce Linton that we're doing with the Daily Dive. It's going to be an exciting interview. It's actually my first time ever chatting with Bruce Linton, so that's going to be fun. And aside from that, thanks for joining us, and we'll be back tomorrow at noon. All right, thanks.